Hello and welcome to today's SGI webinar, What Mama Didn't Tell You About BHRs. My name is Dan Marks. I'm SGI's Director of Content Development, and I'll be the moderator for today's program. On behalf of SGI, I'd like to welcome you and let you know our webinar system allows you to ask questions through your computer. So if you have questions at any time during the presentation, even now, feel free to submit them and we'll get to them at the end of the formal presentation. Before we get started, I'd like to introduce our two speakers. We have Tom Williams and Joe Polanco, both of New Direction Partners, who have a great presentation together today, and I'd like to pass it first to Tom Williams. Tom?
Hello, everyone, and thank you for joining this webinar. Hopefully we have some information that will be valuable to you in managing and running your businesses. I have been involved in printing-related businesses my entire career, initially selling capital equipment, and then getting involved in the financial services business with a firm that we grew over the years and focused on financing the printing and packaging industries. That firm was sold to GE Capital about 20 years ago, and I became involved in turnaround and restructure consulting for a number of different industries, and was one of the 4 original founding partners 10 years ago, New Direction Partners, which focuses strictly on the printing and packaging industries. Joe?
Good morning. My name is Joe Polanco, speaking to you from sunny Southern California. I've been with New Direction Partners for 3 years. I'm a fairly newcomer to the firm, but have a long industry career. Started in the early 70s on the West Coast, and spent much of my time in Texas. Started off with commercial printers, customer service estimating, spent a lot of time in general management, running commercial printers back in the 80s. Then spent quite a few years with the Printing Industries of America, running their Texas operation, but I had the opportunity to do quite a bit of analysis for many printers across the U.S. and in Texas on financial management, and have spoken on budget hourly rates and quite a bit over the years, and have done quite a bit of work with printers, probably over 100 printers over the years to help them develop their own hourly rates. And also did a bit of work with Phil Ruggles on his estimating book, which is still the only book on printing estimating out there, and had an opportunity to do a little bit of work with him there, and so semi-published, for lack of a better word. So it has been an interesting career, and still at it, almost 50 years later. Let's go ahead and talk a little bit about New Direction Partners. Tom, you want to go and fill the folks in a little bit about what we're doing?
Yeah, New Direction Partners, as I mentioned, was formed 10 years ago. Myself, Jim Russell, who had a large printing company up in the Midwest, very active in printing associations. Peter Schaefer, who formerly was president of Compass Capital Partners, which was the forerunner firm in the printing and packaging industries. And Paul Riley, former CEO of Senveo. We saw an opportunity with the contraction in the commercial printing industry to start this business, and we focus on representing buyers and sellers in the printing and packaging industry, business consulting, valuations, and raising capital. That's the short story. Okay, let's get started with the program. We're going to talk about budgeted hourly rates today, which is the industry's de facto pricing and costing tool. All industry pricing software uses budget hourly rates, or BHRs. It's the most effective way to allocate operational costs in a custom manufacturing industry. And of course, the printing industry is a custom manufacturing industry, most companies being what I would call job shops. Is there a weakness in the budgeting hourly cost concept? Do they really measure costs? I think in our opinion, we'd say no, not really. There's more to it. Next, Joe. Budgeted hourly rates. There are three types of rates. There are direct costs, which are your labor costs, your taxes, cost of your benefits, your machine costs, of course, capital costs, the cost of investing in your production equipment, your maintenance cost of utilities to run your business, the supplies and software related, et cetera, and full absorption costs. These are your general, administrative, and selling costs. Full absorption rates are common. What are the challenges? One, of course, is allocation. Indirect costs or overhead are allocated by various formulas. Some of the formulas that are used for allocation are square footage, business activity, business investment. And these costs are adjusted by chargeable hours. If there are 1,944 hours in one shift per year, obviously there's no way all of those hours can be chargeable to your clients. 80% of chargeable hours would be a little over 1,500 hours a year. Typical chargeable hours on a one-shift operation are closer to 1,360 hours, or about 70% of chargeable hours. And as noted, most firms base costs on 70%, and 85% is considered the upper limit. All right, Joe, I'm going to let you do the heavy lifting here, and I'm going to turn it over to you at this point and let you go through the meat of our presentation.
Thank you so much. And Tom's laid out the foundation of what we're going to talk about with our budgeted hourly rates, the different structures. There's a lot of ways to get there. But what I want to go through right now, even though this is not a how-to model, I want to quickly lay out how a budget hourly rate is formatted or created so we can understand its weaknesses and strengths. And I think one thing that we have to be cognizant of is that pretty much every MIS system in our industry uses budgeted hourly rates as part of the, we'll say, the estimating process. So they're a very integral part of the industry and have been for many, many, many years. So what I've got here is just using a grand format printer as a model running on one shift, and I'll give you a quick rundown how that we comprise these costs. So as Tom said, we've got three components. We have direct labor, machine cost, overhead cost. All total is our full absorption cost. So in this case, our direct labor cost would be the cost of the operator, fringes and benefits, taxes, all the things that are associated with that individual. That's going to be what we call variable or direct cost to the facility. And for an operator of this type, $46,000 a year when you include all the different aspects of labor costs, the benefits of health insurance if you're paying for that or allocating for that, FICA, FUTA, all the different associated labor taxes as well. And again, that could very well variable up and down depending on what kind of benefits a company offers, and it's going to vary by company by company. Machine costs are going to be the amortization costs. Normally, we use an amortization cost for the for digital equipment about 3 years. Some companies might use another number that's a little bit farther out, but again, it's going to vary on what's appropriate for that kind of device. And included in this number is also going to be any kind of supplies, not click charges. We're talking any kind of digital device, but anything that's directly, we'll call it supply oriented. It may be maintenance, it may be things of that area, utilities, all those costs are allocated back into that machine. The whole idea behind this concept is to develop cost by cost center. So it may be a device, it may be a department. And in total, we want to be able to develop a rate that reflects the investment equipment. So when we're doing our estimating, and we're saying something takes 4 hours in a device or 3 hours in a department, we'll be able to appropriately allocate our overhead cost, indirect cost to the job, and then mark it up properly. So that's the whole concept behind budgeted hourly rates. As I said earlier, all MIS systems use these price lists. If anyone's using a price list, someone at some point in time went through this drill and been able to create that price list. So here we are back again to overhead cost. We are talking about here all the indirect costs. This is the cost of administration, indirect sales cost, rent, insurances, all of those costs that aren't directly applicable to a certain job. We know that a certain job is going to take a certain amount of labor, a certain amount of machine, but it's all those other costs, the estimator, the front office personnel. We've got to find a way to allocate all those costs back into our cost center. This is what Tom had talked about earlier. There's a variety of methodologies that are used here to allocate those costs, and we can talk more about that later on. But for the sense of the example, we're going to use $168,000 allocation, which talks a total cost of $307,300. Now, these are what we call value-added costs. There is no cost of materials or click charges or anything that can be allocated to a job that may be specific to that job. As Tom mentioned, we're custom manufacturing, and that's going to change job to job to job. So what we've got here, those kinds of costs of substrata, those things that vary from job to job are not included here. All we're talking about is the cost of labor, machines, and administration. So when we come up with that total cost of $307,000, we're going to then budget amount of utilization. We're going to anticipate, and the budgeting process, that's why they call budgeted hourly rates, that we're going to, 70% of the time, we're going to be selling this cost center. So we take that $307,300 divided by 1360, which Tom had mentioned earlier is at 70% for one shift, and that comes to $226 an hour. That's the cost, if you want, that is allocated to this cost center. And theoretically, we want to charge $226 per hour to break even. If we charge that number and we are able to achieve 70% utilization in that year, we're going to cover all the costs allocated to this one cost center. Again, this is done for all our different cost centers, all our different types of equipment. How do we go about doing that? And if we're able to hit our targets, we've covered our cost. But here's reality. This is the first weaknesses that we see in budgeted hourly cost. Let me walk you through this. And again, if you are behind or I'm going too fast or something you want to ask a question, please let Dan know so that we can stop and answer that question so there's no confusion out there. So our budget hour, we're looking at this month by month. I've got April, you take a look, 226 is our budget hourly rate we're using. That's in our MIS system. That's where we're basing all our estimates on for this cost center. We budgeted 113 hours in our model. But as you all know, in actuality, that's not going to happen. We're not going to hit 70% each month. We may have in April 80, in May 70%, in June 68%, in July 60, and August, which typically in the industry tends to be very slow, 50%. Those are the amount of hours we've sold or chargeable. So the actual hours you'll see there are down the bottom line of what was really charged. Now here's the, a second for my slide. Here's what happens, and I think it becomes fairly obvious. We have what's called over or under absorption. If we're charging $226 for that cost center in April, and we've actually sold more hours, we've actually over-absorbed overhead that month because we actually have $3,600 to the good. Our actual hourly rate that month was really $197 because if you took our total cost for the month and divided by the amount of hours sold, we're at $197. But as you see, each month it's going to vary. The ones that are really concerning, of course, are the red months. Those are the months that we actually weren't able to sell to our target amount of hours, and we've actually not absorbed that overhead. We've not charged enough in that period of time to cover that overhead. So that's a concern number one, but a bigger concern is that we are not changing our dollars, or excuse me, our cost every month. We can't. We have to be able to use numbers that are really reflective of the marketplace. So this is the next issue we're going to talk about. So we have overabsorption, underabsorption, but also, as I suggested, I've done quite a bit of these over the years, is that the market is really driving pricing, not cost. We may want to know our costs. We may want to be able to use costs in our equations and being able to get a good idea what's going to cost us. But in reality, it's the marketplace that's going to drive your cost. So I can come up with a number. I can do all the cost accounting in the world that I've done and come up with a $226 an hour rate. But in reality, all I can charge is $150. Now, why is that? I think most of us know. You have many competitors that, one, are just bottom feeders, and they're just going to go out after any kind of business and whatever it takes. And we see this much more frequently nowadays, you have larger operations running multi-shifts. So, for example, this $226 is based on one shift. Well, the guy running 3 shifts might be at $140 or $130 an hour, and is basically setting the price in the marketplace. So now we have another situation here that we have to now use $150 in our MIS system to create a competitive price. But we now have a situation where we've underabsorbed our overhead by another $103,000. And this becomes a problem when we talk about measuring cost. So let's talk about reality of budget hourly rates, of what's the challenges we have to deal with. First off, in budget hourly rates, we're treating all costs as static. When we develop that cost for $226 an hour for that piece of equipment, and if we use that cost is going to be throughout the year. We're not going to be able to change it every month depending on our utilization levels. Our customers just aren't going to sit for that. But more important, we've got to meet the market. So we may not be able to use that $226. We end up with a dollar number that's much less than that, and we have to meet the market. So therefore, we now have a situation where we're using $150 an hour as our base in our MIS system, and we, after a given period of time, we start thinking about that as our cost of that cost center. That's what the MIS system says, that's the cost, but in reality, it's not. As we said earlier, one, we have a number that was artificial to begin with because we had to change it, and second, because overabsorption, underabsorption, depending on utilization, hours sold, that cost is fluctuating on a regular basis. So we really don't have that $150 an hour, or whatever we have in our MIS system, is not truly our cost. Also, what happens with full absorption rates, we ignore the effect of materials. All of us, if you take a look at the general commercial printing market space in its broadest sense, we're talking digital, our wide format, our signage folks, our general commercial guys, probably material costs represent almost 40% on average of your sales price. And I'm talking about your paper, your substrata, your click charges, any outside purchases. Very easy that it can comprise 40% of your sales. So when we're doing budget hourly rates, we're ignoring that part of the job. And if we're marking up and selling, we're not reflecting all our, or if you want to call it, markups and margins that drive the cost of the job. And as I said earlier, competition is going to force changes in our cost allocations. We have multi-shift competitors, and we have, especially today, we have technology that's changing at a very rapid basis. So again, you put an iGen that you may have running on the floor, also someone across the street's put an HP 12,000, and you're competing with them. Well, all of a sudden, the whole game has changed. You have now basically 2 different devices running very different types of formats, sizes, speeds, what have you. And if you compete in the same spot, now we have different things going on there in the market space. And again, how do you compete with those folks? Well, you still have to know your cost. We want to approach that a bit differently. So let's talk about what's the fix. How do we go about find a better way? We still have to use budget hourly rates. There's still a very good model in being able to develop the constraints of our job. So many hours in that department needs to be charged to reflect the investment over here versus over there. We still have to go through that. Our MI systems are built that way. So we still have to look at those, but let's better understand them. Let's look at different approaches. In my experience, and in talking to many folks throughout the industry who have studied this much longer than I have, we really have to look at activity-based pricing. Really, and there's been shifts quite a bit to this type of concept over the years. Activity-based pricing is really what you hear about called value added and contribution, because we do have an industry that's each job, each product we produce have different variable costs involved. The variable cost being the cost of materials and the cost of labor is going to vary job to job to job. For example, if you're building widgets, you can pretty well tell that each widget's going to have 10% material and it's going to have 15% labor. That's the way the cost accounting works, and you know you're going to build so many widgets in a month, not a problem. In our industry, it doesn't work that way. One job's going to use one set of substrata, the next job's going to use another substrata. One job's going to be on your grand format printer, the next one's going to be on your commercial litho offset device and digital device, as well as a silkscreen device. That varies dramatically job to job, so we have to find a different way to think about how we're creating profitability in our industry. So activity-based pricing accounts for all direct costs and contribution to overhead. I'm going to talk about that a bit later on. Define that as key metric. That value added and contribution are the key metrics we have to look at when we start looking at how we're going to make our company profitable. We also have to need to move away from a job costing mindset. Now, many of you may not be job costing, but this is a mindset that's been around the industry longer than I've been in the industry, and probably going back to the turn of the last century, back in the 1900s, that we have to measure the profitability of each job. We have to look at our job sheet. We have to look at how much work we put into it, what was the estimate, what was it actually cost us, and we then look at each job and say, oh, that job made money. No, that job lost us money. We've got to get away from that mindset, and I'll talk about it a little bit later on why that's important. We really have to measure our performance by our product and or our client. That's the way, and we have to measure it on profitability. So let's continue this concept here. This again may be a little old school for most of us out there, but just want to make sure we all understand what value added is. The value added concept says, look, take your sales dollars, let's subtract the cost of paper, chargeable materials, that would be your ink, your direct supplies. If your click costs are allocated in this area there, that's part of your what we call out-of-pocket costs. That's part of it. Any outside purchases are included in the job. So when you take sales less those items, your materials, substrata, your chargeable materials, and your outside purchases, what's left is value added. That's a value added that you are creating in your operation. Now, contribution is a very similar concept, but it takes one more step. Contribution is what I call value added on steroids. It takes one more. We include our direct labor costs as well. But the concept being that direct labor varies job to job just as much as material costs do. So we just are now taking a little more granular approach in measuring our we'll call contribution to overhead. Contribution to overhead is, hey, after I sell my job and I write a check for all my paper materials and outside purchases and my direct labor costs, what's left, the contribution to overhead is critical. That are those dollars that are going to be able to cover the cost of my rent, my utilities, my note on my equipment, etc. Contribution to overhead becomes a real critical aspect here to understand. So let me walk you through a little modeling here to give us a better approach, and maybe hopefully this will help us understand our weaknesses and strengths. What I've got here is a sort of a quasi-estimate, very simplistically created for two different jobs. We'll call it job A and job B. Each job is going to have some sort of substrate involved, chargeable materials, outside purchases. We have some pre-press of 4 hours at $90 an hour, which we, percent of argument, will say it's a market pricing number. We could, it doesn't matter what we have there, but we're calling it $90 an hour. Some print production and some finishing. Each of those costs are extended across the columns that you see. So when I add up all my total costs for job A, it's $1,768, and for job B, it's $2,463. I'm going to assume a standard markup here across the board on all the both labor materials. And again, this is again modeling. You may do it a bit differently, but just to give us an idea of how this model works. We have a markup and we have a selling price. So we have a selling price for job B of $2,709, job A $1,944. If we're not measuring value added or contribution, what we see here is job B is a preferable job. There's more sales involved, okay? This is the way many of us think. We're looking at, hey, the larger the sales dollars, the better opportunity we have to create profit for our business. That model, or as one of my friends likes to say, that dog don't hunt in our world. So let's break it down a little bit more here. Let's look at some value added analysis. Now, when we take our value added, the selling price and above is still the same as we're talking about. No changes there. We see our selling price at 1944 for job A and 2709 for job B, but the value added for those jobs is really what we're focused on. Remember, value added is going to be the selling price plus the cost of substrata, materials, and outside purchases. And again, one of the reasons I separated those items up above is so I can be able to calculate my value added. So you see that even though the job B may have had $800 more of selling value, in reality, there's only a $70 difference in value added. And again, the reason being very obvious when you look back at the job is that our substrata cost and our outside purchases represent quite a bit of the job. Those are dollars that are being paid to someone else to produce or provide materials rather than us creating value added within our shop. Let's take another step further. Let's look at the same way we're going to do a contribution analysis, a little more granular. So with contribution, what we started doing, we want to measure our direct costs. We know what our direct costs for materials and substrata and outside purchases is, no change there. But now we're going to measure our pre-press, print production, finishing cost, our labor cost. So we've gone through the mechanics of calculating those hourly rates for those individuals for their labor, fringes, benefits, and also for their utilization. That might be a 6-month rolling average, which we normally use quite a bit to calculate a number there. But we now are measuring what's the actual cost of our labor. Our direct cost is going to vary job by job. So in this case, in our contribution model, we've now taken that 2.5 hours of pre-press times a number that's going to give us 75, the same for the print production and for finishing. So now we're measuring our total direct cost in not only our materials, but also our labor. A little bit more granular. So now we look at our sales dollars less our direct cost, and that's going to be what's called contribution. $1,026 for job A, $1,096 for job B. Again, that $78 difference we talked about earlier, that hasn't changed, but more important though, this is what's the dollars that are left over after we sell this job. It's going to cover the overhead cost. But also we need to take one more cut at the apple here. You need to look at your sales compensation. Most printers, print providers, whatever we want to call ourselves out there, pay sales reps on sales. So we have a situation here where we have a discrepancy in job B, which had a lot higher selling price, but in value-added perspective of contribution is almost identical, but we're paying a higher commission. So when we look at the net here of after you take out sales compensation, you have two jobs that for all intents and purposes are exactly alike, no difference. So why am I going through this routine? Again, to give you a concept of what you really need to be looking at is value added and or contribution, either one, but you have to be looking at that job by job rather than looking at the budget hourly rate. What did my budget hourly rate say I made is for profit? Because this is what drives our profitability for our firm. It's very critical. And we have to understand the dynamics of a sales price that's higher doesn't necessarily mean it's good for the business. Now, we could adjust this very easily. I mean, we just mark up job B higher to give us the value we'd like to have. You know, if we mark that up to a higher number and we say, look, we're going to go ahead and mark that up so we get a profit value. That number is a measurement of net contribution divided by sales. That just gives us our profit value for the job. And let's say our profit value is 45. We mark up job B to get us up to that 45 profit value. That's what we want. We want a profit value for every job that comes in our shop of 45. Now, if the market dictates that we can't sell for that, okay. We then can make some decisions of, hey, we're willing to take that job for less contribution than we would normally want, or if you're looking at value added, we can mark up less. But now we know exactly, rather than hanging our hat on budget hourly rates that we've been using for years that truly don't reflect our cost of doing business for the reasons we talked about earlier, we're looking at drivers here that are very, very real and actually can be tied back to your operating statement. And that's what this is about. How can we make sure that our operating statement, which we show our bank, we show everyone else involved, and Uncle Sam, that's really where our money is. How can we tie in our analysis of job by job pricing and our cost analysis to say that can tie into the cost sheet? I'll talk about that a little bit later on in a second as well. Let's go next to a more broader perspective. So we talked about job by job, but really what's important is not only job by job, we also have to look at our total operation. We need to look at, as I said earlier, we need to look at our products we produce as well as our clients and analyze who's really profitable and who's not. So in this case, I'm going to walk you through, this is a model I worked off from a client, an old client of ours, and it's pretty realistic. We did modify it a little bit just to show the numbers, but we are kind of reflective of what we saw with this one firm. We have what's called commercial. This is going to be in this business was all the general commercial printing, predominant litho. And you had the paper cost. Again, we're breaking out in the same format. You have paper cost, you have ink, supplies, materials, outside purchases, and total material cost. You have direct labor cost, direct selling expenses, and then you have a contribution number. Now, again, most of today's MI systems have the ability to do this, to be able to capture. If you code your work properly, it'll capture not only the sales by that product, this is called product line costing, by the way, and you allocate materials properly, you'll be able to capture all this material and have this kind of an analysis. So in this case, we can take a look at this kind of work, shows what our sales was for the kind of work we produced, the contribution, and our profit value. Again, profit value being contribution divided by sales. We can also allocate some direct factory costs, show what our gross profit was and our gross margin for that business. And let's do that for a whole bunch of different lines of business. Let's do that for our direct mail business, some newsletters, magazines, wide format mailing. I mean, this, again, each business is going to have different product lines, and you can do it by product. You can also do it by customer, which I highly recommend. But let's take a look for this example here. So we can take a look at each, we've got 6 products, and let's look at PV for each product. We can take a look right there quickly, which work is not as profitable as other work. And let's say now we know that our mailing in wide format has a fairly high PV because there's not a lot of equipment involved with those areas, so levels have higher profit values. But let's take a look at our newsletter business versus our direct mail commercial business. All of a sudden, we see a dog, very bluntly. We see a aspect of our business. Yes, it's generating contribution. We know that's it's generating some dollars to our overhead. $333,000. That's good, but the margins aren't where they should be, not compared to other products. So we start to now as managers, start making decisions. Do we change our pricing to get us where we would like to be with the rest of our business, or do we look at inefficiencies in the system? Do we have inefficiencies in our paper cost or our direct labor that's driving this PV too low? But this is what's important, is to be able to analyze the profitability of this work that we have. We may think, hey, this is generating $1.1 million for our business. It's great. We love it. Our great customers. They're easy to work with. But profitability of that work may not be as much as we'd like to. So that's positive contribution, which is a positive, but it may not be where we'd like to see it. So again, these are ratios that you can look at and run month to month, quarter to quarter, year to year. It's just a matter of setting up your MIS system to handle this. And you can, again, here's the whole thing broken out, including GA expense and selling expense. And what is important here, when you do these kinds of measurements properly, when you use the right kind of tracking, and you compile this on a job-by-job basis in your MIS system, you now have a way to actually tie into your P&L. And I guarantee you it can be done, because I did that for many years, is that when your job cost system is set up properly, reflecting the right kind of cost, you can tie into your P&L. I've known many printers who have tried to take all the job cost sheets, add them up off their systems, and because, as we talked about earlier, their budget hourly rates aren't really measuring cost properly, et cetera, they come up and say, oh yeah, we should have made $200,000 in profits this month. Yet when the P&L comes in, it shows a loss or shows a number totally drastically different. The reason being that you're not measuring the same things. You're not measuring the same things in a job cost sheet and your estimating system as you do with your P&L. You have to find a way to get those closer together to you're able to really see off your estimating, off your job cost sheets, that yes, that truly is my cost. And then I can make some decisions. And again, what we talk about is measuring direct cost, not necessarily these full absorption costs. Let's talk about a few takeaways from today's presentation. We need to continue to use, I'm not saying rates because they're not reflective of your cost and you want to change something different. Your system right now is built, or your spreadsheets you're using, or your price list you're using, are reflecting your cost in the marketplace. That's important. As we all know, we have to compete in the market space. But what we need to do is to get a better grasp of where is the profits in our business coming from. Is it from job A or top job Bs, or is it from certain customers? We need to, in that case, start looking at thinking about developing our direct cost so we can, in our budget hour rate, so we can start seeing where that real profit's coming from. The next challenge is developing direct cost of labor by your department cost. You can do that relatively easily because, again, direct cost of labor, as we talked about earlier, is not only the cost of the individual, but the benefits that are associated with the individual, the taxes, et cetera, et cetera. That's a fairly straightforward, easy cost accounting analysis to be able to do. I normally suggest that because utilization, and you need to track utilization. That's critical, by the way. You have to be able to track utilization. That's the amount of hours being sold in each month so that you can properly allocate in this scenario. What we normally recommend is a 6-month roll. That is to go from January to June, all the amount of hours sold in that period of time for that cost center, the cost of your direct labor, divide the hours into the labor to come up with an hourly rate. Then the next month you drop off January and add July. So you're able to see this month-to-month change in your labor cost, but you're reflecting a fairly accurate number there for your direct cost of labor, without the crazy fluctuations you get if you wanted to change those numbers every month. But at least you get a fairly good scenario or aspect of what that cost of labor is, and along with the cost of your materials. So you can now start measuring value added as well as contribution in the kind of work you're doing, and incorporate that in your pricing as well as into your financial statement reporting. We then have to, again, create those tools that are going to measure the cost by job, product, customer. And we talked about value added. Being able to use value added is a good tool. A lot of folks use value added because it's fairly simple to calculate. I have no arguments with that because basically it's your cost of sales, your sales dollars less your cost of materials, outside purchases, et cetera, et cetera. Contribution is a little bit more complex, a little more granular because now you're measuring direct cost of labor as well. And it's a little more challenging, but I tend to lean that way just because I want to be more granular. But really, if you can measure value added, understand that value added is really what you need to be looking at pricing and your cost. It's critical. As a secretary, you also have to truly, if you're not doing it, you need to find a way to do active measurement of your capacity. That means start tracking utilization, your plant and cost center. How many hours are being sold each month? Those hours were overtime. It takes a bit of cost accounting. It takes a bit of work to do that, but I tell you what, the rewards are great later on because we start actually starting to see trends in your capacity of your operation, but also you can now find ways to see how that changes your profitability month to month. When you start seeing those utilization numbers changing, you're probably going to see a direct correlation with your profitability. More importantly, you can start using that to truly create cost for your cost centers that are reflective of what those costs are. And that's important. So when you look at your estimating sheet and you say, okay, my cost sheet says I've got $500 of cost in this cost sheet on my estimate, I've got to take my markup and do whatever. We have to remember that that MIS system is not giving us that cost, that $500 cost of labor, for lack of a better word. We're going to ignore in this example the cost of our direct materials. We have to remember that's not really our cost. That's what the system is saying in the marketplace is our basis to be able to market and sell to. Most MIS systems have the ability to also layer in another set of costs. And this is where we come back when I talked about developing direct cost of labor. You can then, even though you're using $150 an hour to sell to in a certain cost center, you can also allocate, let's say it's $45 an hour of direct labor because that's the calculations you've been making, and know that that's your cost of direct labor. You can now layer that into your MIS system and into your estimating. So when you look at your estimate at $500 of BHRs, for lack of a better word, that's in your system and drive a price, tells you to sell a job for $800. More importantly, now you have a way to actually measure not only your direct cost of materials, but your direct cost of labor. And you can now see, there's my contribution. I can now measure, there's my sales dollars, there's my direct cost of labor, materials, there's my contribution for that job. Do I want to then change my pricing? Am I completely comfortable with that price and that's what I'm going to sell for? Or do I need to increase to get it to where I need to? Or if it's competitive, I know where I can drop it. I know that I can drop it down to here rather than blindly guessing at how far I can drop it to be competitive and still make money. And you can do the same thing with the value added. Value added, again, it's a challenge to be able to develop those hourly rates for your direct labor in your system. You can still use VAs, that kind of tool, and help you make that understanding of what's really driving everything. So again, in capturing what we discussed here and sort of closing our conversation, is that budget hourly rates, as many people understand the industry, full absorption budget hourly rates, normally are not really reflective of the cost of operation. In most cases, those hourly rates have been modified to reflect something in our MIS system to help us generate prices. So that $100, $90, $400, whatever that number is that you're using in the system, more than likely does not correlate to the actual cost. We have to understand that. More importantly, we have to understand what's the differentiation. If I'm using $400 an hour when my costs are really $800 an hour, I've got to find a way to determine what am I taking? Is it really generating profit or not generating profit? Am I really in a market space I really should be in? Maybe I shouldn't be selling that product. So that's another reason why you have to have product line costing, to be able to take a look at these cost centers in aggregate by product. So these, again, tools are hopefully that you can take away, think about. For some of us, this is very standard. This concept's been around for many, many years. It's not commonplace in the industry, but the good thing I'd like to make a comment on is that I'm seeing more and more firms using this kind of mindset as they go forth and look at their costing, their estimating, their pricing, and it becomes a tool that's very valuable. And I think if you start looking at the companies in the industry that tend to be more profitable, they tend to understand these things. They understand the contribution, they understand value added, and they know how to use it and where the weaknesses are with budgeted hourly rates. And in closing, that's really what this presentation was about. Let's not take budgeted hourly rates as the end-all, be-all. We have to understand that there's strengths for them and there's weaknesses. We talked about their strengths and weaknesses, and we also talked about some other concepts that we can tie into that to help us really look at profitability of our work, be it by client, be it by product. And main thing is that we are really in the profit business. As a print provider, you have to generate enough profitability to be able to be in business, and hopefully these kinds of tools can help you get there. Dan, I would like to be able to say we've wrapped it up and see if we have times for questions from the audience.
Yep, we have time for just a couple quick questions. The first one is, the strategies that were presented in the presentation here were really interesting to me, and in some cases, you're really instituting almost a cultural shift within the way a company addresses its costs. And in your experience, who are the key stakeholders in making this happen within a company and also making it stick?
Good question, Dan. I think this always goes back to the CEO, because what happens here when you start changing this culture, first off, you have to change your estimating mindset. And larger companies who have a single estimator, they have conceptually a certain way of thinking of measuring cost and looking at costing, and they have to understand what's going on here. So that you've got to be able to have management, your owner, your CEO, driving that mindset that, look, we've got to change the way we look at things and we've got to be consistent. Mm-hmm. That CEO also has to drive this into the sales force. The sales force is key here, because if they don't understand or feel comfortable with what's going on, they're going to bow their necks and it's going to create a lot of problems. They have to understand why we're going to use a different model to be able to adjust for our markups and pricing and target pricing. They have to have a buy into that. I'm a firm believer if you're using a VA system for pricing, pay your salesman on VA or value added. Don't pay them on gross sales, because that's a fair way for them to be paid for the company as well as themselves, because they can now understand if I take on this work and has a higher value added, I get a bigger cut of the pie. Versus, as we saw earlier in my model, if you're basing it on sales, they're always going to end up driving their, because they're compensated that way, they're always going to be driving to higher sales. The only way you can get that mindset change is from the CEO. It can only happen there. And I'll tell you right now, in my experience, that's normally the fly in the ointment, is getting your sales force to buy into this.
Got it. Okay.
Don't do what I did years ago. I changed the contribution methodology with my sales force and didn't do a 6-month roll. I'd implemented immediately, and we had winners and losers overnight, and boy, did I have problems. If you're making these changes, you want to make that over a period of time to give them to understand how it's going on, what's happening, and where you're driving your business.
Okay. And
hopefully that answered the question.
Yeah, thank you so much. And Tom, you had mentioned before the presentation that you have a calculating spreadsheet available. Can you tell us a little more about that?
Actually, it was Joe who has the spreadsheet that he'd like to distribute.
Oh, sure. Okay. Joe, do you want to tell us a little about that?
Yeah, just it's I've used that spreadsheet for about 30 years in a variety of places. It uses a different allocation methodology. It uses more of a capital investment allocation of overhead. So what the spreadsheet is, very simple Excel spreadsheet, and I'll be glad to send it to you, Dan, and you can allocate it to anyone who would like to have it. It's going to calculate your direct costs. It's going to calculate your machine rates as well as your full absorption, if you really want to know those numbers. It's all you need to have is your P&L or a good budget and a good depreciation schedule or amortization schedule for your equipment, and your department by department allocation of labor. And the spreadsheet does it all. So it's a good tool to have, and it's simple, not sophisticated, but it does the job. So I'll be glad to share that with you, Dan, and you can share that with the members participating.
Yep, sounds great. Go ahead and send it my way. I just sent out a chat message to everybody that's with us. If you'd like that spreadsheet that we're talking about, just go ahead and send a request to dan@sgia.org, and I will send it your way. That's all the time we have for the presentation today. So Tom, Joe, thanks so much for the presentation.
You're welcome.
And for those of you who joined us today, we hope you found the presentation to be worthwhile, and we hope you came away with some new strategies for managing your costs. So with that, I urge you to check sgia.org for our upcoming webinars, and also go to printingunited.com and sign up for Printing United. It'll be the biggest printing-focused event in North America, and it's coming up October 23rd through 25th. So we hope to see you there. Thanks for joining us, and we'll see you online again soon. Bye-bye.
Thank you, everyone.